This report has been prepared by Tutorial 11 Group C for ACW1012 unit. The team consists of 6 members. Together, the group aims to analyze the financial and ethical position of Solartech Components Sdn Bhd, a medium-sized Malaysian manufacturer of solar panel components located in Penang. The purpose of this report is to evaluate Solartech's financial viability and ethical sustainability considering the recent environmental, social, and government challenges. Despite operating within the renewable energy sector, the company relies heavily on electricity from Malaysia's coal-dominated power grid, resulting in relatively high carbon emissions per unit of output. Furthermore, Solartech has been criticized for its lack of workplace diversity, as less than 50% of its 250 employees are women and senior management positions remain predominantly male. To address these issues, Solartech plans to implement several compliance measures from 2025 onwards, including the installation of rooftop solar panels, upgrades in energy-efficient machinery, and diversity and inclusion programs. While these initiatives are expected to strengthen Solartech's long-term competitiveness and reputation, they also increase short-term operating costs and financial pressure on the company. This report will therefore analyze Solartech's break-even and cost-volume profit position before and after compliance, develop a 3-year cash budget projection, and reflect on the ethical implications of the company's decision-making process. The overall objective is to determine whether Solartech can maintain financial stability while fulfilling its ethical towards sustainability and workplace equality. First, we start with financial viability, the break-even and cost-volume profit analysis. Let's begin. With the current situation, Solartech's fixed cost is 7 million. The variable cost per unit is 10 and the selling price per unit is 15. This gives a contribution margin of 5 per unit. That's 15 minus 10. Using the formula break-even point equals fixed cost divided by contribution per unit, we get 7 million divided by 5 equals 1.4 million units. So Solartech must sell 1.4 million units in 2024 to break even. Next, let's consider the impact of Solartech's new ESG compliance initiative, namely the solar and efficiency upgrade costing 1.4 million and diversity and inclusion programs costing 600k. These costs are treated as fixed, so total fixed costs rise from 7 million to 9 million. With the same 5 contribution per unit, the new break-even point becomes 9 million divided by 5, which equals 1.8 million units. So after implementing ESG measures, Solartech now needs to sell 1.8 million units to cover all costs. Thank you. Now I'll be passing to Mindy.
Currently, Solartech annual sales volume is 2 million units, and this is above the new break-even level of 1.8 million units. At this level of sales, the total contribution is equal to 2 million times 5 ringgit, which is the contribution per unit, and we will get 10 million ringgit. After deducting the new fixed cost of 9 million ringgit, Solartech still earns a profit of 1 million ringgit. The current sales volume remains adequate. To strengthen profitability, 2 separate cost recovery strategies were considered. Scenario A is to increase the selling price by 40 cents per unit. By raising the price from 15 ringgit to 50 ringgit 40 cents, the contribution margin increases to 5 ringgit 40 cents per unit. The expected profits become 2 million ringgit times 5 ringgit 40 cents minus 9 million ringgit will equal to 1.8 million ringgit. This is the expected profit for scenario A. Then scenario B is to increase sales volume by 12% without changing the price. In this scenario, sales increase to 2.24 million units by calculation. With contribution per unit unchanged at 5 ringgit, profit becomes 2.24 million ringgit times 5 ringgit minus 9 million ringgit equal to 2.2 million ringgit. So scenario B produced 400,000 ringgit more profit than scenario A. Now let's compare the risk. Scenario A financially risks lower demand. In competitive export markets, customers are price sensitive, so a 40 cents increase in price could trigger customer defection to cheaper or greener suppliers. Non-financially, it could harm Solartech ESG reputation, as passing costs directly to customers might undermine the company's credibility in sustainability commitments. How about scenario B? Increasing 12% in sales volume might lead to overtime, maintenance, or higher material costs, which could raise variable costs and reduce margins. Non-financially, scenario B is strategically aligned with Solartech's ESG goals, which suggest that sustainable investment are attracting more business and improving competitiveness.
Hello everyone, my name is Kamiyang. We are now moving on to the cash budgeting and compliance challenges. In this section, I'll walk through Solartech's projected cash position from 2025 to 2027, highlight any cash surpluses or shortfalls, and discuss how well the company can sustain its cash flow while pursuing ESG compliance. Let's begin with the baseline year 2024. Solartech recorded 20 million in cash receipts and 60 million in operating payments, leaving a net inflow of 4 million. This 4 million can become the opening balance for 2025, marking the start of its ESG transition period. Now in 2025, Solartech enters what we call the transition year, the most financially demanding stage, when its major ESG initiatives officially begin. Cash receipts fall by 5% to 19 million due to weaker demand and reputational challenges, while operating payments surged by 40% to 22.4 million as the company invests heavily in solar panels, new machinery, and diversity programs. That gives a net cash outflow of 3.4 million, leaving a closing balance of 600,000. Although liquidity looks tight, this shortfall is actually strategic. Solartech is deliberately trading short-term cash for long-term efficiency and stronger ESG credibility, so 2025 represents an investment phase, not a financial weakness. Moving into 2026, we start to see early signs of recovery. Receipts increased by 5% to 19.95 million as customer confidence begin to return, while payments remain 20% above the 2024 baseline at 19.2 million. This results in a net inflow of 750,000, bringing the closing cash balance to 1.35 million. This positive movement shows that the company ESG strategy is beginning to pay off, lower energy costs and a greener reputation, and translating into healthier cash flow and profitability. By 2027, Solartech enters the sustainable growth phase. Receipts rise another 7% to 21.35 million, while payments grow by just 5% to 20.16 million. That leaves a net inflow of 1.19 billion and a closing balance of 2.54 million. At this stage, Solartech's earlier ESG investment have clearly shifted from short-term cost to long-term value creation. The company is now generating more inflows than outflows, supported by stronger cost control, higher productivity, and a renewed client trust. Overall, if you look at the 3-year trend, the story is clear. Solartech moved from a planned deficit in 2025 to a steady surplus by 2027. The initial shortfall represents strategic reinvestment, while the growing surpluses prove stronger cash generation and long-term stability. Even at its low point, Solartech maintains positive closing balances, showing solid treasury management and the ability to handle short-term pressure without external financing. When we consider long-term viability, the ESG initiatives are already delivering measurable benefits. Solar upgrades are cutting energy costs, while diversity and inclusion programs are improving morale, innovation, and the company's brand image. Together, these factors attract ESG-conscious clients and investors, linking sustainability directly to profitability. So, in summary, Solartech's cash budget isn't just a financial forecast, it's a reflection of strategic value creation. The shift from deficit to surplus shows how responsible investment builds both resilience and trust. By 2027, Solartech achieved not only profitability, but also credibility, proving that sustainability, when managed strategically, strengthens both the company's financial health and its reputation.
Now, to strengthen liquidity during this ESG transition, we recommend 3 key financial strategies. First, Solartech can seek green financing or ESG-linked loans to fund its solar and diversity projects. These financing options often come with lower interest rates and performance-based rewards, helping the company reduce short-term pressure while staying in line with its sustainability goals. Second, adopt a phased capital expenditure approach. By spreading major ESG investments such as solar upgrades over 2 years, Solartech can smooth out cash outflows, reduce the heavy burden in 2025, and even benefit from early saving that improve cash timing. And third, the company should take advantage of national grants and incentives such as Malaysia Green Technology Financing Scheme or HRD Corp training grants. This help offset ESG-related expenses and reduce reliance on internal cash reserve. Collectively, this strategy maintains cash stability and ensures Solartech can continue its ESG journey with financial confidence and long-term resilience. Overall, the 3-year projection shows that Solartech financial strategy successfully balanced sustainability with profitability, turning short-term cash drains into lasting competitive advantage.
Hi, I'm Carmen, and now I'm going to continue with the ethical reflection part. The first major ethical challenge faced by Solartech is its high carbon emissions. Although it operates in the renewable energy industry, the company still depends heavily on Malaysia's coal-based electricity, making its emission among the highest in the sector. This creates a contradiction between Solartech's green image and its polluting production methods, raising ethical concerns about greenwashing, which is appearing eco-friendly while still causing harm to the environment.
Hi, I'm Melissa. Now I'm going to continue the second key ethical challenge. The second ethical challenge is the lack of workplace diversity and inclusivity. Only 15% of 250 employees are women, and senior management is dominated by men. This imbalance raises concerns of fairness and equality, and reports of biased hiring and limited career progressions for women and minority employees have hurt Solartech image as a fair employer. Financially, this leads to lower engagement, higher turnover, and difficulty attracting skilled talent, which weakens investor and client confidence in Solartech ESG commitment. To address this issue, Solartech invests RM600,000 into a comprehensive diversity and inclusion program, including gender balanced recruitment, mentorship, and leadership training. Together with RM1.5 million spent on environmental upgrades, this raised total fixed cost from RM7 million to RM9 million, increasing the break-even point from 1.4 million to 1.8 million unit. Although the sales dropped by 5% in 2025 due to reputational issue, Solartech still operates above break-even with 2 million units sold and showing that it remains financially viable while pursuing ethical reforms.
However, this initiative also brought short-term financial pressure. The 40% rise in operating payments in 2025 shows the upfront cost of implementing inclusivity and sustainability project. As a result, Solartech faced a temporary cash deficit of RM3.4 million. Nevertheless, this was a planned investment phase aimed at achieving long-term goals. Encouragingly, signs of recovery soon followed. By 2026, as cash receipts increased by 5% and Solartech's reputation improved, the company began to recover financially. The closing cash balance rose to RM1.35 million in 2026 and further to RM2.54 million in 2027. This shows that ESG investment can bring sustainable financial and reputational benefits over time. Now I'm going to talk about the risks that arise if the company prioritizes short-term profit over ESG reforms. First, reputation and revenue loss. Ignoring ESG reform may cause clients to see Solartech as dishonest and end their contract. This would worsen the 5% sales drop and make it harder to reach the break-even point of 1.8 million units. Since Solartech must sell 400,000 more units to reach the break-even point, losing customers will delay profitability. Second, legal and compliance risks. Weak environmental and inclusivity practice could lead to fines or stricter government monitoring. With global laws on carbon emissions stagnating, Solartech may face trade restriction and lose export opportunities. Poor compliance also harms Solartech's global reputation. Third, lose access to green financing or face higher borrowing costs. Weak ESG performance may make investors see Solartech as risky and raise borrowing costs. This could worsen the RM3.4 million cash deficit and slow financial recovery. A weak ESG rating also lowers investors' confidence and market value, limiting the company's long-term growth. Lastly, higher turnover and recruitment costs. Delaying D&I program may cause employees to leave, forcing the company to spend more on hiring and training. Low morale and less diversity will also reduce innovation and further raise operating costs, which have already increased by 40%. In conclusion, Solartech must balance profit with strong ESG actions to ensure lasting success.
To balance financial recovery with ethical responsibility, the first strategy is to adopt a phased approach to ESG investment rather than spending the full RM2 million upfront. This spreads costs for solar panels, energy upgrades, and D&I programs across several years, helping ease short-term financial pressures while ensuring steady ethical progress. The second strategy focuses on cost recovery measures. Under scenario A, increasing the selling price by 40 cents raise profits to RM1.8 million, while scenario B, boosting sales by 12% lift profits to RM2.2 million. The extra funds can be reinvested into sustainability and inclusivity effort, showing that profitability and ethics can move together. The third strategy is enhancing efficiency for long-term gain. Solartech investment in LED lighting, heat recovery system, and modern machinery increase fixed costs, but it reduces energy use, carbon emissions, and long-term operating expenses. Next, rebuild reputations and stakeholder trust. After the negative publicity and 5% drop in cash receipt, Solartech is now improving transparency through sustainability report and stakeholders briefing to rebuild credibility and attract new investors. Finally, the last strategy is to leverage green financing and government support such as GTFS loans and HRD corporation grants, which help fund ESG projects without draining internal cash. This ensures both financial stability and long-term ethical commitment. Overall, DeFi strategy prove that ethical responsibility and financial performance can work hand to hand to build a stronger and more competitive Solartech.
In conclusion, Solartech financial and ethical transformation demonstrate that sustainability and profitability can reinforce each other. The break-even and cash flow analysis show that while ESG compliance initially increases cost and tightens liquidity, this investment quickly translates into long-term financial gains and improved stability. By 2027, Solartech achieved both positive cash flow and stronger market confidence, proof that responsible decisions lead to lasting results. Ethically, the company commitment to reducing emissions and promoting inclusivity rebuild trust and align its operation with global sustainability expectation. Going forward, SolarTech should continue balancing growth with accountability through phases, investment, transparent reporting, and effective use of green financing. Overall, SolarTech journey illustrates that true business resilience is not only measured by profit margin, but by its ability to grow responsibly, ethically, and sustainably. That's all for our presentation. Thank you for listening.